Yeah. So the way we think about the portfolio construction is really the overarching theme and philosophy is about diversification. So generally, we want to be presented and then have exposure across the entire cap structure of the underlying assets. So in this respect, we're investing both in the liability and the equity side, because simply you cannot really expose yourself to one single risk, even if it just promise you higher returns. So private credit itself is an important element within this whole liability segment we're investing. And the way we see it is it's just a complementary toolkit and an important accretive value driver and a return driver to the overall portfolio construction. So in this respect, we're trying to avoid having overlap with, for example, other strategies within the alternative investment universe, because there's some idiosyncratic elements that you want to avoid. So you won't see us being overly active in the sponsored lending side, for example, because tends to be some correlation to the private equity classes as well. At the same time, I'd also say that, on the liability side, it is also a standalone asset class where you can find risk and complexity premium, which is not, for example, available when only investing into the fixed income side. So it's not a replacement for the fixed income itself. Private debt is a little bit complex than private equity, for example, because it has limited upside and huge downside, if I may exaggerate that way. So in this respect, you make sure that you're top of the capital structure in the underlying assets. So you have the legal rights to enforce if something comes up that is not really as you've underwritten to. But you have the ability to invest across the whole capital structure within the liability structure and side of the underlying assets. But if you have to go into the subordinated side of the assets, you make sure that you have the right team in place and partner in place that is able to enforce the outcome in your favor if something goes really not in the right direction. So the relative value component actually is an overarching theme, and this is something that we've primarily looked at it when investing into segments and also region. So I will say that, on an absolute return basis, returns that are presented to you are really appealing. But then take into account, like trying to, compare apples with apples with European or North American situations. For example, taking the, example of direct lending, it's a different understanding than the cash flow based lending that you see or you exhibit in the North American, European markets. So it's more comparable to special sits type of situation and strategies. And take into account the FX cost, the premium is just getting to a level where it doesn't really become so appealing at first glance. But we're truly believers and we're convinced that the diversification element is so important because Asia still is about a local content and local growth story. So in this respect, they can be accretive from a diversification perspective. And if it still offers you 1% to 2% of what you can get in North American or European markets, then from a diversification perspective and return attribution, it is an interesting element to it. I think the first lessons learned is actually not to generalize and consider Asia as one piece, right? So there are various regions and countries that have different development patterns and characteristics. And it really depends on the situations that you invest in. So for example, Australia, I would say it's almost comparable with the North American, European market. So I would say you have the sort of similar underwriting standards and you don't have to take into account some premium for the risk you're undertaking. But let's take an example for India or China. This is a completely new story for us. And also, you make sure that you team up with the managers that are, or have been, and are investing actively in those regions with a boots on ground to really do what they need to do in order to source deals, monitor deals, and probably also drive the value creation if needed. I think, this market, the Asian market, again, generalizing, although it's not the right approach, but simply speaking, Asia itself is probably, few cycles behind the European markets and even more pronounced profoundly to the North American markets. So in this respect, I will say the direct lending or corporate lending is still an important element to it. And again, each region, each country is different. So if you want to invest into Asia, I think the first movers on the PE side would probably start with a Pan-Asian fund manager. Given the resource intensity of such a strategy that private debt requires, I don't think this will work because, again, you need the kind of a local content, you need the local presences in order to do things you want to do in a way that you want to do. So in this respect, you probably need to do, just really cluster approach by looking at the different regions and countries. And in this respect, I would say, for example, in Australia, just to name a few, it's this classic story about how private debt, for example, evolved in the North American, European markets. Banks are trenching out, just only few available. And this is a classic story where you can really reap premium because you're teaming up with someone who has a bargaining power with them, to support the financing of market companies. And then there are some other developed markets where the sponsor market has been in a good state of development. So there is a certain element of that you can run a corporate direct lending strategy. But then there are some situations, and most of the situations here are asset-backed situations, which I would say is comparable to the special sits. And given the state the overall corporate lending market is, I think there may be some special situations arena and stress situations that you can actually participate from.